Welcome. My name is James Sackey. I'm the marketing director for the Vant Group and your host for the quarterly Deal Pulse, where I'm interviewing top deal makers.
So I'm a partner with Blank Rome.
So in Escor, we are a direct lender.
For their insights and their feedback.
I think on some of the sell side, you've got some companies that are in a little bit of trouble now.
On what's going on in the transaction world. Let's get to it. Thank you all for joining us today. I'm joined by my friend and colleague, Brice Reid. He is Senior Vice President of Business Development at Nfusion Capital. Brice, tell us about yourself and tell us about the firm.
Yeah, my name is Brice Reid, obviously. I'm from Dallas, Texas, grew up, born and raised here. My firm is called Nfusion Capital. We are an asset-based lender as well as a factoring company. We started, I believe, 2017, so we've kind of hit the ground running per se. It was started by Jason Lippman after he used to be at a group called Far West Capital, which was acquired by a bank. And when that happened, I think what can sometimes happen when banks acquire factoring companies or ABL shops, the credit box got tighter. So he decided to start his own group called Nfusion Capital. And we have grown like a weed. I mean, our company started out mainly doing construction deals, which for most people in the ABL and factoring space know that's usually a no-go, a no-touch zone, which kind of led to a lot of natural deal flow for us from other shops, which helped us grow into a more well-rounded group where we are generalists. Our deal size, we've gone a little bit more upstream, is really $1 million facility size all the way up to $50 million. So our capital availability, I've got a really large sandbox that I can play in. And we're generalist. I know everybody says that, but we really are. There's not a deal that we at least won't take a look at and scan through and see if it's something we can figure out and wrap our hands around. As long as the collateral's there, we really are aggressive at trying to get things done and being creative, trying to come up with a solution or platform for our clients. But yeah, that's a little bit about us. We do manufacturing, work with staffing companies, oil and gas service companies, subcontractors, apparel, consumer product goods, food processing, you name it. We've probably taken a look at it or gotten something done. And again, most of our clients are typically doing anywhere from $5 million annual revenue up to over, $500 million.
Awesome. I know alternative financing has seen quite a bit of surge in activity in the last couple of years too. So I know you're a busy guy. So that kind of swings right into my first question. Are you seeing, as far as deal flow, increase in deals or decrease or flat?
I think industry-wide, at least from the feedback that I've been getting, it's been maybe a little bit slow, which sometimes happens with summer. Kids go on vacation with their families. People are out of office, stagnant with, other entrepreneurs. But we have not really on our end seen a slowdown. It's been maybe a little bit slower than normal in getting things actually done. But deal flow, I'm as busy as I've ever been. A lot of our deal flow is coming from banks turning down deals, sponsor-backed groups knowing that they're probably not a fit for a bank. I think from what I've been seeing, banks have been a little bit more conservative than normal, but the private credit side, we've seen other players kind of enter the group being more aggressive than maybe they traditionally would be. Since the past few years, maybe they haven't been deploying capital.
Yeah, that lines up with what I've been picking up as well, with banks kind of stepping back a little bit and private credit stepping up even more for sure. So that might swing into my next question, maybe. How have client behaviors changed in the last 90 days?
I don't know if it's changed that much. I think people are coming to the realization that a bank, while it might be the cheapest option, is not always the best option. And you get deals where banks are just straight up passing on a deal, or they're giving them less than sufficient credit than that they actually need. There's two things at play there. It's like if they're passing on it, they know that a lot of these clients still need some type of, cash flow funding. So we're always a good option. Or the clients are continuing to look, maybe the bank gave them $1 million line and, they've got collateral where they're like, look, I've got $5 million in receivables. They want more liquidity and access to it. So they come to us, even though it's a, more expensive cost of capital. What's the cost of doing business if you pass up on getting access to that capital?
Yeah, that and speed. And we know time kills all deals. So
yeah. Banks typically take a little bit longer than us. Smaller deals we can typically get, done and funded within the, time span of, 5 to 10 business days. ABL, we look at a bank asset-based group, they're going to probably take 2 months. It can take us, 3 to 6 weeks to get something done. And on top of that, we're nimble enough at our shop size to where we can typically get term sheets issued within 72 hours at the latest, and some of these other private credit groups that are with larger funds can take up to 2 months to issue a term sheet. So that's kind of what makes us unique, is our speed to close. We're not usually, and don't want to be, the cheapest cost of capital or the cheapest deal on the street. But when we issue term sheets, I mean, we're 85% strike rate. We're going to close those deals.
Yep. Are you noticing any recurring red flags that are killing deals?
Yes, which I've been seeing for a while. I mean, tax issues are always an issue, but I've been seeing a lot of MCAs. They've been more prevalent than ever. I've been in this industry for a decade now. I feel like when I started, they were kind of an issue, and then they kind of went to the wayside. A lot of them went bankrupt, but they are back in full force. They're attached to at least 50 to 60% of all the deals I look at, where they've got some extremely, exorbitantly expensive debt that sometimes they can't even cover, and we have to pass on deals. It's a last resort loan that has become a first resort for a lot of different industries and sectors. So that has been one of the largest red flags I've seen. They're out there, and it makes it tough for us to get deals done. If they've got this cost of capital that's so expensive and they can't service our debt, we can't do the deal.
Yep.
And typically they're unsecured. So the only way to really monitor that is by getting bank statements.
Yeah, for sure. So let's go a little bit more macro. Are you noticing any activity in particular industries or deal type, perhaps?
I haven't seen too many shifts in industries that I'm seeing activity in, but I am seeing some stronger deals that are leaning more towards the ABL side as opposed to factoring, where they're actually making money or have made money for the past couple months. Deals that I would traditionally think maybe banks would take a look at, but aren't doing. Maybe it's an inventory heavy component or an equipment heavy component on the line, and banks don't want that exposure. But I've seen some stronger companies as of recently, as opposed to in the past. And that probably is connected to why I'm seeing a lot more deals from bankers in our market, as well as other sponsor-backed deals.
So what's one piece of advice that you've been giving clients more often this quarter than you were last, if any?
If they heed my advice, don't wait forever on a term sheet, because sometimes they don't even materialize. Even if they get a term sheet, the deal could fall through at loan committee closer to close. So, again, I'm sometimes off on pricing compared to wherever some of these private credit shops may be. If you're waiting, I've seen some of these deals that have come back around that were, I put a term sheet out in January, and here we are June, and they still don't have anything. And it's like, might as well strike now. What's the opportunity cost that you've passed up on in the past 6 months on getting something done?
Yeah.
So that's some advice that, is obviously somewhat biased, but also is very real. I've seen it. People sometimes think, if they've been kicking around forever and they can't find something might not magically appear.
Yeah.
At bank, some of these banks are somewhat similar. If you've shopped it out to 10 and nobody's done the deal, I don't know how many takers you're actually going to have.
Yeah, I would agree. There's only so many that you probably want to talk to before you realize these are the options that you've got, and that's about it.
And banks really want deposits too. So, that makes them a lot more appetizing. If the bank is going to do the deal, if they're willing to move over the deposit relationship, specifically on larger clients, it might make them a little bit more inclined to be aggressive. But that doesn't necessarily mean they're going to close the deal either. They might get the deposits moved, and then something ends up on the back end.
Yep. Okay, so final question. Let's look forward now. If you had to bet on one shift coming in M&A or the transaction space, what would it be?
I think you're going to see a lot more private credit in the marketplace, but I think some of the deals that I'm seeing them put term sheets out on now are one, price too cheap, and they don't make sense long term. And I think when that happens, when one of these deals blows up, or a few of them in their book, they're maybe not managed properly or priced incorrectly, I think you're going to see what has happened over and over again is they're going to start tightening up their credit box. Their appetite's going to decrease, and we're going to kind of go back to the norm. Like, you can't be offering these rates that are basically bankable on private credit. I get that they have to deploy capital, but that's one of the things that I see. It's not their money. So they're doing deals at like some things that I turn down, or, we price in the risk and they're coming in extremely cheap, like bank rates. And I'm like, just take that deal and run with it. But long term, that's not realistic.
Not sustainable.
It's not sustainable for the whole market. I mean, look, we're in this to obviously help our clients, but there's got to be some type of reward for the risk that we take. And when you make it to where it's such a thin, profit margin, again, everything's going to correct itself, I would expect, over the next year or so.
Yep. Good insight. Good insight. We'll see what happens there. Brice, I appreciate your time. I appreciate your insights. For those of you that are watching, I hope you find this information useful. To find more insights from our Deal Pulse, you can check us out on our YouTube channel, as well as LinkedIn and the website at thevantgroup.com. Brice, thank you for your time, sir.
Thank you, James. As always, you're a great connector.